What's up guys, it's Kev, and I'm assuming you know who these guys are and how they throw money at startups hoping to make ridiculous returns in their investments. Investing in startups is referred to as venture capital, which is very similar to angel investing. However, the angels typically come in first, followed by the venture capitalist once the business is more established. Missing out on a winning company can be a brutal experience. Just ask Kevin O'Leary. He famously lost his chance at investing in Ring, a startup that sold for $1 billion to Amazon when he could have invested at a $7 million valuation. Investing in startups, i.e. venture capital, can be extremely profitable. However, it's a little unfair because historically not everybody has been legally allowed to invest in startups. Until somewhat recently, it was actually illegal for regular investors to invest in startups because regulators deemed it too high risk. But thanks to updated laws, now we all can. Today we're going to cover a few things. What is venture capital? The role of venture capitalists, how you can become a venture capitalist, and finally, key considerations you need to make before making your first venture capital investment. And yes, there is a way to get started with as little as $100. That wasn't just a clickbait title. So venture capital is a type of investment that's designed to help startups grow rapidly. VC funds are usually backed by large institutional investors like pension funds or banks. These investors will provide funding for startups in exchange for ownership of the business. Now this means that if the startup does well, so do its backers, but conversely, if they fail, they'll lose it. Now VC investing is not at all like investing in stocks. It's way higher risk and also way higher potential reward. A typical venture capitalist is often a high net worth investor that has both the financial ability and the risk tolerance to invest large sums of money in these promising but high risk startups. With that being said, it's known that the best venture capitalist is the one who can offer the most help and support to the company, not just write the biggest check. Now to become a VC, there's typically three primary paths. Number one is financial expertise. Number two is past entrepreneurial success. And number three, which is the newest, it's equity crowdfunding. To go the finance route, and there really are no hard rules on this, I've generally seen private equity and investment banking to be two of the more common paths into a VC fund. Knowledge of how to structure financing rounds, having a Rolodex of investors you can bring into future financings, and experience with mergers and acquisitions are some of the most critical finance skills that can be of great help to the startups and the VC fund itself. On top of that, it also doesn't hurt to have an MBA. However, even more common than that, I've seen more people get into VC by starting their own successful startup first. This is the entrepreneurial success path. Growing a company from scratch is a very unique skill set, and one that comes with a ton of growing pains. So who better to guide a startup than somebody who's already done it before themselves? VC funds will always have something that's called an executive in residence that not only brings core startup and scaling expertise, but specific subject expertise related to the industries that the fund invests in. Based on these paths, it might seem that startup investing is only reserved for high net worth individuals rather than your average working class citizen. And to that point, I present the final path, equity crowdfunding. Equity crowdfunding is relatively new and it's by far the most simple path for an average person to get into venture capital investing. Startup investing became much easier in 2012 with the passage of the Jobs Act in the US, which relaxed some federal securities regulations, made it easier for businesses to seek money through equity crowdfunding. Though the rules vary by country, the general idea is that regular people can invest in startups, but they're limited by the amount of money they can invest, and the startup is limited by the amount of money they can raise. There are lots of equity crowdfundings popping up all the time, and in a future video, we'll review them all and give you our favorite. Be sure to take a look down in the caption because in the future we will come back to this video and link what we deem to be our favorite platform. In the meantime, I'm going to rattle off a bunch of platforms. WeFunder, Fundable, CircleUp, Republic, Microventures, Start Engine, Netcapital, Seed Invest, Mainvest. And for our Canadians, there's three: FrontFunder, Vested, Equivesto. These crowdfunding platforms will let you sign up and invest with as little as $100. That's the minimum. So that means to get started, all you really need to do is sacrifice 18 Starbucks lattes, or a fancy dinner, or 10 drinks at a bar, or arguably the hardest sacrifice, a matching set of these potty putter toilet putting sets. How to get into VC is the fun part, but now the really important section, the critical warnings that you need to know. I'll say it again, VC is incredibly risky. Though I've seen a few different stats, generally 80 to 90% of startups fail completely. Because you gotta remember, there's a lot of dumb people out there with terrible ideas.
Can you stick that needle in your head every night to charge it?
Yes, you would.
Investors with half a brain can generally sift through the really bad ideas and save themselves. But with that said, even seemingly good ideas can fail, sometimes for reasons completely out of your or the founder's control. For this reason, critical lesson number one is to always be diversified. In venture capital, returns generally follow the Pareto principle, which means that 80% of your wins will come from only 20% of your investments. Now, if you're building a portfolio of stocks and bonds and 80% of your investments flop or do nothing at all, you need to fire your investment advisor immediately because that is a serious serious problem. But with VC, you're swinging for the fences, so it's to be expected that you're going to strike out a few times. The idea is that your winners, though few, are going to win so big, the rest of your portfolio becomes virtually meaningless and irrelevant. Critical consideration number 2 is to understand liquidity, and in this case, the lack of it. Liquidity is your ability to turn an investment into cold hard cash. With large cap stocks, it can be done as quickly as with the click of a button. Private companies, it's way more difficult. If you intend to be a VC investor, you need to know you might not get your money back for 5, 6, or even 7 years. I mean, it takes time for that startup to use your money to grow and eventually get towards a liquidity event, which as an example is usually an acquisition by a larger peer, possibly a private equity fund, or maybe an initial public offering of shares. Your VC investments won't pay for your groceries or your utilities. You need a different income stream for that. Finally, our last critical consideration, invest in what you understand. It's so simple, but so important. New industries and new technologies are always exciting, but if you can't explain it to a child in a few sentences, you don't truly understand it. And that means you're at risk. Believe me, it is so easy to be fooled by charismatic CEOs claiming that their product or service is going to change the world, and they can be convincing. But oftentimes, once you peel back the layers, you'll realize there were critical assumptions that were made that might not actually turn out to be realistic. The only way to protect yourself is through superior knowledge. You can't be tricked if you're a subject expert or if you have access to people with that expertise. I have a group of people in my network that I lean on that have extreme expertise in space commercialization, hydrogen energy, artificial intelligence, blockchain, and many other critically important industries. I rely on their expertise before I place even a single dollar into any of these companies. Now, if you don't have access to people like this, the internet can still get you most of the way there. It's just going to take more time and energy. But with that said, I'll remind you that your net worth is your network. So get off the couch and go meet some people. Now, as I mentioned, one possible liquidity event is an initial public offering of shares to the public. In this case, you can deposit your shares into a brokerage and pretty much simply just click sell. Now, most of the time, companies are significantly massive before they even consider doing this. However, I've been involved in something called public venture capital. This is where early stage companies go public much sooner than they would typically on junior stock exchanges. In the US, it's the OTC exchange, and in Canada, we have a few, primarily the NEO, the Canadian Securities Exchange, and the TSX Venture Exchange. Equity crowdfunding is definitely gaining popularity. It's still far more common for VC investments to be reserved for ultra high net worth individuals and institutions. Public venture capital allows for the everyday person to get in on some of this action. It can be extremely profitable. I specifically have made a lot of money specifically on this, but it comes with a ton of warnings. You really need to know how to play this game if you have any chance at winning it. I want you to click this link on the screen and watch this video I made going over all of my rules of everything I've learned in the last 5 years of specifically focusing on public venture capital. Before that, I was an equity analyst at 2 of North America's largest funds. But before you go, if you found this video useful, I'd love it if you gave me a like and subscribe so that you can see future videos.